Welcome to the deep dive. We are jumping straight into what is really the crucial source material of the week. It's the Q3 fiscal year 2026 earnings call held after the market close on November 25th. And we're focused on a cloud software leader that, by all accounts, delivered an outstanding quarter, a huge beat on profit. But then it faced this immediate, just ferocious backlash from the market.
And that right there is the puzzle we are here to solve for you. Because management gets on the call, they sound incredibly confident, they're touting all this progress in AI, platform momentum, and then the stock just falls off a cliff. It dropped nearly 8% in the next trading session. So our mission here is to really dissect the numbers, dissect the narrative, and find out what went wrong. What did management say, and what detail in the guidance absolutely spooked the market?
Okay, so let's start with the good news, the beat. Because it was a powerful one, especially on the bottom line. Non-GAAP diluted earnings per share came in at $2.32.
Which is just a staggering number. Wall Street was looking for something between, $2.13 and $2.18. We are talking about a 7 to 9% beat on profitability. That tells you right away that their efficiency plans, the cost controls, they're working faster than anyone thought.
And the growth was clean.
Yeah.
Total revenue, $2.432 billion. Up almost 13% year over year, right in line with what people were expecting. GAAP EPS was also strong, climbing 31% to 94 cents.
But the underlying profitability, that's really what matters here. Non-GAAP operating income margin expanded to 28.5%. Just think about that. That's up from 26.3% just a year ago. That margin expansion, it's the direct result of management deciding to get really disciplined on profit.
And you can see it in the bank account. Operating cash flow grew an incredible 45%. That's up to $588 million. Free cash flow of $550 million. You look at the last 3 months in isolation, this company is just firing on all cylinders.
Absolutely right. The fundamentals are excellent, which, brings us right back to the central question. If everything was so good, why did the stock close down almost 8%? The volume was just massive. The sell-off was the market basically screaming that it didn't believe the story.
Well, and you have to remember the context, right? The options market had priced in a move of maybe 5.5%. So when the actual move is almost 50% bigger than that, it tells you some piece of new information just profoundly changed how investors see the future.
It signals that the market looked at that great Q3 beat and said, that's table stakes.
Mm-hmm.
Investors weren't interested in the past quarter. They were, hyper-focused on the next year. What they heard there, it just wasn't good enough to justify the price tag.
All right, let's dig into the financial structure then. Where's the money coming from? The engine, of course, is subscription revenue. That hit $2.24 billion, growing about 14.5%. Stable, predictable.
Yeah, and you can see they're really pushing customers toward partners for the setup work. Professional services revenue was down a bit at $188 million. And that's totally intentional. They want the high-margin subscriptions, not the low-margin consulting stuff.
So if subscriptions are the present, the backlog tells us about the future. The 12-month subscription backlog, what's called CRPO, that grew 17.6% to $8.21 billion.
And the total subscription backlog, which is, contracts stretching years out, that hit almost $26 billion. Up 17%, and that includes the recent Paradox acquisition. So it signals strong bookings. Customers are signing very, very long-term deals.
Okay, now let's get to the core of it, the growth thesis. AI monetization. Management was, they were almost bursting with optimism here. They gave out some metrics that genuinely shocked people. They said AI solutions contributed about 1.5 percentage points to total ARR growth this quarter.
But the real shocker wasn't the 1.5 points. that's a decent start. It was the adoption rate. Listen to this. Management said over 75% of all net new deals.
75%.
75. And 35% of customer expansions included AI capabilities. That means the whole conversation with the customer has changed. They're not just selling software anymore. They're selling the intelligence on top of it.
That is a massive attach rate. But let's zoom in on the specific example they gave, because this feels like a peek into the future for the whole software sector. They talked about their hired score recruiting agent.
Yes. The hired score example is probably the single most valuable data point from this entire call. They are selling $2.50 worth of the AI product for every $1 of the standard recruiting product.
Wow.
That's a 250% price uplift just by attaching the AI.
So Does that just fundamentally change the entire lifetime value calculation for a customer? You're not just selling them software anymore. You're effectively hiking the price by 2.5 times just by bundling in the intelligence.
It changes everything. It means the ceiling for revenue per customer just shot way, way up. And if 75% of new customers are already taking it, they clearly see the value. The real question is, if adoption is so high, why is the ARR contribution only 1.5 points for now?
Right.
And the answer is likely that these contracts have ramp periods.
I thought.
Financial acceleration is probably just getting started.
So you've got this incredible AI story, but at the same time, the company is prioritizing efficiency. That margin expansion to 28.5% we talked about, that was explicitly linked to the restructuring they did in February, which hit about 8.5% of the staff.
It's a painful trade-off,
Yeah.
but they clearly chose margin discipline, and they're seeing the benefit right away, and they're returning that cash. They bought back over $800 million in shares this quarter, and they announced they're accelerating the plan to buy back another $3.6 billion.
So they're targeting $5 billion total.
Exactly. Management is showing massive confidence in the fundamental value of the business, even if growth is slowing down for a bit.
Okay, so let's move from the balance sheet to the strategic vision. The theme was all about becoming an enterprise AI platform, moving beyond just being seen as an HCM or ERP provider.
They're trying to build an ecosystem, one where people, money, and AI agents are all talking to each other on the same system.
Yeah.
And you see it in their M&A. They closed the Paradox deal, the Sana deal, and announced they're going to buy Pipedream.
And that Pipedream one, the low-code integration platform, that seems critical. Management kept talking about building an enterprise AI fabric with new features like Illuminate AI agents and a consumption model called Flex Credits.
It's all about seamless integration. They expanded partnerships with Microsoft, with Google BigQuery. It's about keeping their data moat secure.
And speaking of moats, they're winning in these really sticky, high-margin industries. Healthcare is now their 6th industry to pass $1 billion in ARR. That is a huge milestone.
And let's not overlook the government traction. The U.S. Department of Energy successfully went live. Now, for our listeners, that's the first cabinet-level agency on their FedRAMP-authorized cloud.
Okay, so why does that matter so much?
Because FedRAMP authorization is a stamp of approval. It's the highest level of security. It basically opens the door to the entire intelligence community. And that one success sets up a $15 million Q4 revenue contribution from the DIA contract, the Defense Intelligence Agency.
Wow.
And management is already negotiating expansion. These are 10 to 15-year contracts. Unparalleled stability.
They also talked about going down market, pushing into the mid-market with their Workday Go offering, expanded it globally, introduced a new AI deployment agent that's meant to cut implementation time by up to 25%. That's how you win that segment.
And so we finally arrive at the reason the stock sold off, the forward guidance. Despite all this AI momentum, all this operational excellence, investors focused like a laser on one thing, the trajectory of future growth.
The specifics were what? Q4 subscription revenue guidance of $2.355 billion. That implies about 15.5% growth. And they raised the full year guidance a bit, but if you look further out, the path is definitely slowing.
This is the absolute crux of the problem. Management hit its profitability goal. High 20s margins, check. But the long-term subscription growth target for fiscal 27 is still just 13%. And critically, about 1 point of that 13% is just from acquisitions.
So organically, you're talking low to mid-teens growth. And that's the question, right? If the fundamentals are so sound, if AI is attaching at a 75% rate, why would growth be slowing down to 13%?
This is where the narrative meets the cold reality of the macro environment. Management admitted they're seeing pockets of softness. They specifically called out higher education, which is a huge vertical for them because of federal funding issues, and just general macro uncertainty leading some big customers to tighten IT spend or delay big projects.
That makes sense. A company might be happy to buy the AI add-on, but maybe they push the massive multi-year ERP migration out a bit.
Exactly. And the market is telling them, we don't care about your efficiency, we want acceleration. You have to remember, this stock was trading at roughly 100 times trailing earnings.
100 times.
You pay that kind of multiple for hypergrowth, for acceleration, not for 13% stability. The stock is being penalized because the market saw that cautious guidance as a signal that management doesn't have confidence in immediate AI-driven acceleration.
So the market is basically saying, great quarter, but we needed the guide to be 16 or 17% to keep paying this premium.
Precisely. They are struggling to bridge the gap between their own obvious excitement about the AI adoption and the conservative numbers they had to put on paper for next year.
Right.
And that's the tension right now.
Okay, let's move to our "This is not financial advice" segment.
Right. So we've established that the market has, in our view, massively overreacted to that cautious 13% guidance for FY27. The tension is very real. You have AI contribution at only 1.5 points to ARR, but adoption is at 75% of new sales. The market is pricing this like a boring, stable grower, and it's completely ignoring the long-term AI potential.
So there's a clear narrative gap between the adoption metrics and the reported revenue in the near term. If you believe that AI will eventually accelerate growth, what's the highest leverage way to bet on that?
Okay, so we are pitching a high leverage bet here by Workday call options, but with an expiration date far out, well into calendar 2027. This directly exploits that gap between the official guidance and the, frankly, incredible AI attach rates we're seeing, like that hired score metric.
So the trade hypothesis is all about playing the long game.
It is. The thesis is that those acquisitions, Sauna, Paradox, Pipedream, they will combine with these early monetization wins to push ARR growth back above 15% organically, probably by FY28, well before these long-dated calls would expire. And if growth re-accelerates, that 100x PE multiple is going to re-rate significantly higher. The market's focused on deceleration. We say you bet on the inevitable AI inflection point.
And just a reminder, this is purely our analysis of the source material. It is not investment advice. Please always conduct your own due diligence. So we have seen a very complex picture today. Excellent operational performance, a strong beat, completely overshadowed by conservative guidance that the market just brutally punished.
The key tension for you, as the well-informed observer, is whether this company's focus on those sticky, high-margin wins, the 10-year deals in healthcare, the huge government penetration, that offset the macro pressures they themselves admitted to seeing in places like higher ed and IT budgets.
And we'll leave you with a provocative thought, one that really speaks to the long-term competitive landscape. Management stated they are building an enterprise AI fabric. Now, if Workday successfully uses that Pipedream acquisition to seamlessly orchestrate AI actions across, say, 3,000 external applications, will its data moat make it so indispensable to big companies that it fundamentally changes the game faster than anyone currently anticipates? Something to consider as you digest this deep dive.